Welcome to Looking at the Markets with David Modell. Today we're going to discuss a rather advanced or at least intermediate strategy for options. It's called ratio spreads. And first, let's discuss the other types of spreads. Then we'll get to the ratio spreads. Now, vertical spreads use different strike prices, but the same expiration date and the same number of bought and sold options. Calendar spreads use different expiration dates, but the same strike price and the same number of bought and sold options. Diagonal spreads are a combination of the vertical and the calendar spreads. They use different strike prices, like a vertical spread, and different expiration dates, like a calendar spread, with the same number of bought and sold options, once again. So for all three of these strategies, you're buying and selling the same number of options. What if you bought and sold different numbers of options? Then it would be a ratio spread. So ratio spreads use a different number of bought and sold options. A ratio of 2 to 1 is the most common, but other ratios, such as 3 to 2, are also possible. But we're going to stick to the most popular ratio, which is 2 to 1, for these examples today. All right, so for example, let's say you buy one out-of-the-money Apple put option expiring December 15th, and at the same time you sell two slightly further out-of-the-money Apple put options also expiring December 15th. So same expiration date, different strike prices, but the main feature here is that you're selling more than you're buying. And so that's what makes it a ratio spread. You're selling and buying different amounts of options. So that's an example of a ratio put spread because it's puts. It would be, most likely, it would be a credit spread because you'd be receiving a payment up front since the two puts that you sold would probably have more total value than the one put that you bought. That's usually the case. Well, it depends how you set it up, but most likely it would be a credit spread because you'd probably be selling more value than you're buying. In this example, you'd have a neutral or bullish directional assumption for Apple stock, and you're hoping that Apple stock doesn't go down very much because remember, you sold more puts than you bought. And your maximum loss is rather large because if Apple stock keeps going down below the strike price of the two put options that you had sold, your losses will get bigger and bigger, and the fact that you bought one put option won't protect you completely. Because remember, yeah, you did buy one put option, but you sold more. You sold two of them. Here's another example, and this time we'll use calls instead of puts. Let's say you buy one at-the-money Netflix call option expiring January 8th, and at the same time you sell two slightly out-of-the-money Netflix call options also expiring January 8th. So again, same expiration date, slightly different strike prices, but the most interesting part of this is that it's a ratio spread because you're buying one and you're selling two calls. So that's an example of a ratio call spread because it's calls this time instead of puts. It would be a credit spread, probably. Depends how you set it up, but usually this would be a credit spread because you'd be receiving a payment up front since the two calls that you sold would probably have more total value than the one call that you bought. In this example, you'd have a neutral or bearish directional assumption for Netflix stock, and you're hoping that Netflix stock doesn't go up very far. Because again, remember, you sold more calls than you bought. And in this case, your maximum loss, it's not just very large, it's actually undefined, which is a way of saying that it's potentially limitless losses. Because if Netflix stock keeps going up above the strike price of the two call options that you had sold, your losses will get bigger and bigger, and the fact that you bought one call option won't protect you completely. And I drew a little chart here. This would be an example of a call. This is a profit and loss chart for a call ratio credit spread, profit and loss chart. All right. So here's your profits are up here, your losses are here, your break even is here in the middle. And let's say here's a stock price All right, so when the stock price gets bigger and higher and higher, sure, you collected a credit, okay, and you could do pretty well here, especially if the stock price doesn't go above the short strike, as they say, the price of the 2 calls that you sold. When the stock price starts going above the short strike price here, your profit starts to get lower and lower, and then you get to break even. And if that stock price just keeps going up and up and up before expiration, now you're losing more and more money, and it could go down and down and down. I put an arrowhead there because it's infinite, really. You could just lose more and more and more money, even more money than you have in your account, potentially. So please be careful. Because these types of ratio credit spreads, and sometimes these are called front spreads, by the way, because these types of ratio credit spreads have such large maximum losses, I personally don't use them very often, and I suggest being very cautious with this type of options strategy. Yeah, you almost have to think of it like selling a naked call or selling a naked put. I want you to think of it that way, really, because the potential losses are so big. All right, so that would be a front spread. And I also want to touch upon back spreads. Okay, there's also something called a ratio back spread, in which you reverse this strategy by purchasing more options than you're buying. Therefore, it's probably going to be a debit spread instead of a credit spread. I say probably. It all depends on how you set it up. There are exceptions to all these rules. So, for example, if you sell one out-of-the-money Microsoft call option expiring February 6, but then you buy 2 slightly further out of the money Microsoft call options expiring the same day, February 6. This would be a debit spread, since probably a debit spread, depends how you set it up. But yeah, this would probably be a debit spread since you're paying money up front. Your maximum loss is limited, so that's good, and your potential profit is unlimited, and that's good. But you'll need a big upward move in Microsoft stock in a fairly short period of time to make a big profit with this strategy. Yeah, because theta, or time decay, would probably be working against you, as it often does with debit spreads. And it's tough. It's tough to make a really decent profit with this strategy, although it is possible. So in conclusion, at least with ratio back spreads, it's an interesting way to create a debit spread. But personally, I tend to prefer vertical, calendar, or diagonal spreads. I like vertical spreads a lot just because of their simplicity. I'm not against calendar or diagonal spreads, and I'm not against ratio back spreads either. It's a matter of personal preference. And as far as the front spreads, which I discussed earlier, you really have to be careful. It's something that you won't see me using all that often because of this, because of that unlimited or very large maximum loss potential there. All right. So I hope this video was helpful to you as an introduction to ratio spreads. I know it's sometimes complex, but this is one of the more intermediate to advanced strategies. I have plenty of videos on more basic strategies for options trading, and I hope you'll check those out. And if you like this video, please give it a thumbs up on YouTube and leave a comment if you'd like to, and please subscribe to my YouTube channel and hit that bell on YouTube so you can receive the latest updates on my financial educational videos. And if you want more help, if you'd like some help putting together a trading or investing plan, you can email me anytime. My email address is davidmodell@gmail.com. Thank you so much for watching and listening. I'll talk to you again soon.